Hey everybody, welcome back. Well, as always, it was entertaining this week. You can obviously see how we started off Monday, Tuesday, Wednesday, Thursday, and now Friday. Thursday, obviously, in closing everything over, and then we can just kind of see this doji over here. There's a lot to go through today. Smart money, dumb money, equity risk premium, what it means to you, why the VIX is actually helping us. We're going to explain how to use that. I think the best thing for us to do is just start with the basic indicators and then go from there. So first and foremost, if you just look at the ES, you can see that the S&P futures is still below the 12 and the 55. Volume towards the end of the day dropped off. That shouldn't be that surprising that we're seeing that. But if we take a second here, and again, we're just going to stick with the most basic of charts. This is a 3, a 5, and an 8. Now, what's important about this is I use this on a 15-minute chart, and it's just a 3 and a 5 and an 8. And I just want to go through why I think that this is important. When it flips here for me, because I like big glaring signals. Red on top means stop. Okay, so 8, 5, 3, just like a traffic light. When it's inversed, green on top means go. It doesn't rhyme as much, but there it is. So then what we have is we have the 5 pointing up the way that it is. That's exactly what you want to see. You want to see tests of that 5 now. So this is your first indication that you may be able to start flipping something else, just like flipping the 5-day moving average or the 12-day. Actually, let's get rid of him right now. And let's drill into this. I'm not going to have time to edit because this thing's packed. So we want to see getting over the 12 and go from there and building. What we want to do is just watch in here and make sure that we're going to get finally over that level. People saying, well, you don't have a lot of volume. I don't really care about the volume on Friday. I know a lot of people are going to say that's a problem. For me, just the mere fact that we stopped going down is important. And we'll get into why I think that happened here in some detail. I also think if you zoom out, when in doubt, zoom out. And what you're going to see is the simplest of things. And we're just going through the basics before it starts getting heavy because there's a lot in here. If you just drop a pin, or I'll drop it, I'll refer to it as a pin, but if you just drop a line from there over, you will note that when you get to these kinds of extreme selling reading, they tend to mark bottoms. And you can see that here and here as well. And what's referred to, and you can see it over here as well, it is referred to exhaustive selling. And that's exactly what you had. You had exhaustive selling. So without further ado, and I don't see the need to go through the NASDAQ and everything else, what we do want to focus on is what happened with Japan. But before that, I'd be remiss in not just pointing out this is the Ichimoku cloud. I do use this a lot. And there are some things here that you need to be aware of. When you break down through this, you need to push back over it. You can see the cross here. And that's not the best. So this did happen. Now, does this get legs or does it do something like this? Do we just push right through it? I don't know, but you need to get on the other side of this for those that watch this cloud. I watch it very closely. I do think that you can lift and then kind of go sideways in here, but you just need to be aware of what's going on before we go further. And I'll explain why I do think that you're going to see a little bit of pressure on the buy side here too. I think some people are going to be out of position, but we're going to get to it. To me, it's just important that you guys have all the facts. I really try to focus on that. Let's keep that open. Now, in regards to what happened, Bank of Japan cut rates, or raised rates rather. We're going to cut rates, and we're going to get to that in a second. But when they raised rates, what they did was they unwound what was probably the biggest trade in the market. And this trade was you short the yen, and then after you short the yen, you buy the dollar. After you buy the dollar, then what you do is you buy any asset in the dollar. So in other words, equities or bonds. The majority of people buy bonds. Some people actually bought tech stocks. Doesn't matter. Sell the yen, buy the dollar, buy an asset that's in that denomination of that dollar. Now, they were doing this globally. So understand that when this unwound, this is exactly why it got so crazy. This date right here, you will all remember me pointing out this date. This is July 11th. This was your first CPI reading that was negative. That was negative since what? The pandemic. Let's get this guy right here so that we're not distracted. So this is a really important point for us to get through. Now, during this time, we've had rallies, we've had pullbacks, and we've had flip-flops in here ad nauseum. But where is the money going? And I think that there's an important distinction to make. There's going to be a lot in this video. I'm just going to say that now. There are parts of this that you're going to want to rewatch because I'm just going to pack it in, and then you can replay certain parts of it. But there's a lot in here. I mapped it out pretty well. So what I would start is going, okay, since Bank of Japan did what they did, what has changed? In other words, where are they putting their money? Now, we can see from the 8th over, the biggest volatility is they are just simply buying Bitcoin and anything associated with Bitcoin. I don't know the reasoning for that, the rationale behind that, but you are seeing the Bitcoin names bought, you're seeing the pot names bought, and they are buying semis. Now, that could be because of Taiwan Semi absolutely crushing on the revenue side. But then when you look at it, that's not when it really moved. So I think they're buying IGV. I've got that in there twice. They're buying the home builders. They're buying a little gold. They're buying tech, which is NVIDIA, Apple, Microsoft. They're the top 3 in the XLK. So when you start going through this, they're buying the cloud names. They're buying China. They're buying some of the AI automation names. I think this is really important to look at because when you see what they've done for the week, they've gone risk on, and we'll get to that in a minute. Now, risk on means that they're buying equities that have high beta correlation to the market, meaning strong correlation or move more than when the market moves when it goes up. So they want risk. It's risk on here. Matter of fact, you can see you're even above the NASDAQ. All of these are above the NASDAQ. So if I was so inclined and wanted to know where the money was going, I would understand that the money is going here. Hindsight in technology is a beautiful thing, especially with technical analysis, but we're going to have to drill into this and what the heck's going on out there, but stay with me. In front of us is RSP, which is the equal weight, and then you have the SPY, which is the market weight, equal weight, market weight. This is going to get important later, but if we just take a snapshot from 22 over, we can see that we were in a position here where they were riding the line together. I was going to say riding the lightning. And then you can kind of see right here, all the Metallica fans will know what that means. But now look at the spread that you have here. Okay, that spread is narrowing, and we're going to talk about that later and how you can use that. But let's just kind of take a snapshot of what happened this week and what's going on under the hood. Now, as always, I'm going to be not able to edit this, but we started off very, very sad because all of a sudden stocks are going down and we thought they would go up. And then we started getting news like this, economic red flags. Today's jobs number that came out was really bad. What they're starting to wonder now, did this jobs number have anything to do with the hurricane that happened? And they're starting to look into that. But right now, if you remember that jobs number, it was really bad. Why is this important? Now everyone will be glued to the weekly number that comes out on Thursday called initial jobless claim. Jobless claims, I've been trading over 25 years. That used to be the go-to every Thursday. It's coming back. They're bringing it back. So everyone will start focusing on that. Just remember, over 250 is bad. Bad news is bad again. What has happened and what's really important here is for us to just take a snapshot of, this is CME Fed tool. There's a 100% chance you're going to ease in September. It's not even a question. But 1 month ago, before you had a negative CPI, as I pointed out on that USD Japanese yen chart, you now have 3.7% chance of what? 2 rate cuts. Remember, this is where you're at, 525 to 550. So if you get to 500 or under that, since you're currently the rate's at 530, you're going to be in a position of 475, 500. And there was a 3% chance of that. Then it went to a 74% chance. Then it went to a 50, and now you're at a 49. So it is a coin toss now between 49 and 51. And that would be uncertainty. The market does not like uncertain. So where does that put us next? Okay, so we have the Siegel coming out, and now this is he's actually a pretty good bond guy. Comes out and says Fed needs to make an emergency rate cut. He said 75 and then another 75. Within 24 hours, he said, maybe not. Now, that's really interesting because you only got one data point that came out, but he called and backed off his call for that. I don't know what happened here. I don't know what happened within 24 hours. If I put on my tinfoil hat, somebody got a phone call. And then we had mixed signals at the banks. So you have momentum signals from major indices, and this was by JP Morgan. And basically the Nikkei, which is in gray, is falling off a chart. You can see blue here, and that's the S&P, Euro, and et cetera, et cetera. Dotted line is emerging markets, which obviously get exacerbated. You can see that the S&P 500 fell the least. That's going to be important as we move forward here for you to get that concept that the S&P 500 dropped the least. But what their point was is, yes, that is the bottom. But okay, did everybody think that way? And the answer is no. As a matter of fact, Bank of Japan came out and issued a dovish statement after raising rates saying, everything's fine, we're not going to do that again. And this is where it gets really crazy. In front of you, and I know that some of these concepts are big, but just stay with me and then watch another part of it again if you're stuck. But this shows how that you have been net short this position for literally years. Net short this position for years. You flip to net long And then after you flip to net long, the Bank of Japan comes out and issues a statement saying that, oh, well, we're not going to do that again. So when you start to think about this, everybody covered, and then they went long, and then they reversed their position. And then we saw the CTA models out there. Now, where JP Morgan's saying one thing, Goldman's saying something else, and they're saying 70% of our 63 modeled trend signals are negative. That's not ideal, and you can just see how that's changing the landscape here. So again, tons of conflicting data. Now, for those that trade and understand what gamma is, I thought that this was really important. If you take a look at the spike here and how we've fallen down, that what they were saying is here, any rally, and these people are still completely stuck. Even on a 10% rally, the modeled gamma goes from negative 2 billion only to marginally positive. Dealer long strikes are too far out of the money. Basically what they're saying is the dealers are hosed. And I want to really hammer this point back because it's really important for how we're trading the market. I'm going to spend time showing you between August 2nd and August 7th how we're using this to trade. But you need to understand the amount of information that's out there and how fast it's changing. This gentleman, who I actually do have respect for and understands the market pretty well, within 24 hours, he went from 75 basis points, an emergency cut, with another 75 basis points at September. He went from saying, we need 150 basis points in 8 weeks, or we're going to have a massive, massive problem, to saying, oh, I may have overreacted. So the question is, why did that happen? Now, this was a chart Yardini put out earlier in the week, and I just want to walk through it. It is the dollar-yen trade, and you can see the flip here and what happened to the market. And his point was that you have room to go. Now, at the time of putting this out, I don't think that he understood that they were going to flip to a net long yen position, which changes the complete landscape of this trade now. So I'm curious about the update of this chart and what his thoughts are, and as soon as I get it, I will share it. But I thought this was really interesting. Here's the flip, and from there we just absolutely rip. We actually were following in tandem until we weren't anymore, and then you can just kind of see what starts to happen from 24 on, and that divergence that starts to happen. Now you're starting to have the follow through again. But the idea that these two need to catch themselves up was what was floating out there. It's no longer the case. And again, why am I doing this? Because you need to understand that when you're looking at this market, if you think that this was so simple that you were just supposed to be able to figure out what was going to happen, you're delusional. All right, there's a lot of moving parts here. Cyclicals versus defensive, taking out commodities. Okay, this is the second deviation move in cyclical ever recorded. I mean, it was this and a pandemic from 2007. The great financial crisis didn't even get you to where cyclicals versus defensive. Just think about that for a second. That's how fast this was and what happened. So the idea that you're supposed to be able to put all this together at the same time, that people are coming out there and saying, we need 150 basis points in cuts, and Bank of Japan is flip-flopping, it's pretty delusional to think that you're going to be able to put this all together. That's why short-term trading right now is optimal. What I like to do is just remind everybody on what's going on out there with AI, and I think this is really important. Hyperscaler CapEx totaling nearly $50 billion a quarter, up from $28 billion 6 quarters ago. Why am I showing this? Because sometimes people can't see the forest through the trees. We get caught up in all this, and sometimes when you just go up from 34,000 feet and look down, you can just go, well, wait a minute. We just went through a quarter where Microsoft, Apple, Google, Amazon, and Microsoft just said, yeah, we're increasing CapEx, we're not decreasing it, and we don't really care if you're seeing revenue grow from it. We know where this is going. This is really important, but how do you handle the fluctuation? The best way that I can show you this is I can show you what we're doing right now, and I can show you how I'm taking advantage of the swings. That's the best I can do. And then we're gonna go through smart money, dumb money, equity risk premium, and bring it all home. So what I wanna do actually is show you the NVIDIA trade, but I've been saying this for the week. It's all one big trade. So in front of us are puts that we bought on the S&P, and I will show you the timestamps on this on a second. And you'll also note the date on this, that this is the 7th. And what you're gonna see is, this will look familiar for people that watch these videos. We did the same exact trade on the 2nd. To the T. Different outcomes, and I'll explain that in a second about the amount of money made, and I'll explain why that is in actually a little bit. But what you're looking for here on any of these trades is you're looking to get back to that level right up here, right? You're looking to gap fill, and then you're watching that place of interest. Now, this place of interest right here from August 2nd on, this is when Japan acted. So what we're seeing is that level retested. So once we got up there, and now we'll zoom in on this, make this a 1 minute, and I do want to talk about why we gave this a wider berth, and then I'm going to show you this on a NVIDIA trade as well. It's the same exact trade, and then on top of that, if you come all the way back, you can just follow the line. And all we're doing is getting in right after the retest. And I do want to spend time on this pattern, and I'm going to do a whole video on this as well. There's 2 videos based upon your comments I'm going to do. Number 1 is how you should be looking at these, and then number 2, how to sell or hedge your options after hours. As I did with SMCI and CMG. They're the 2 videos that stick out the most, but a lot of you guys trade these zero-dated options, and frankly, I think you're doing it on the wrong days. But here's your test. That's your test of that gap fill. You're down, you're up, here's your retest. It's that simple, all right? And then you're just using this as your stop. Here's your test, here's your retest, and then you break down. Could you have reversed and gone back over? Yes. You see how all this is in here? Yes. Most people are just going to get out in here of those options. There's a reason not to do that. We're going to discuss that in a moment here. I understand that too, because they're like, oh, I just make what I can get. I make my 50% and then I move on. That's not why I trade options. It's rare for me to do zero-dated options, but there's times to do it. The past couple weeks, there's been a lot of reasons to do it, but you want to see that level. Like, I don't want to put this on and then try to put it back on. That's exhausting to me. Put it on, pull something out. I think we pulled out 25% of that one and then move on. But this one, what we were shooting for, and I'll show you this from the notes in the trading room that John types out while I'm live trading, because when I live trade, John will type for us in the community. But all I want to do is gap fill. That's all I'm looking for. So I test, and then I'm getting out of a chunk. Okay, and this will correlate in a minute with the timestamps. But then here, and I'm out. Like, that's enough. Do I care that you went lower? No, I don't care that you went lower. As a matter of fact, you're going to see with this NVIDIA trade that I did that I'm completely out of it. But this is the same exact pattern that I used on August 2nd, and I want to show you this. And you can go to the August 2nd video. It's there so that you can see this. But what we're doing here is pretty much the same thing. What I'm doing here and what I would suggest that you do with these kinds of trades is mark off the pre-market low area, because you want to see where Asia's involved and you want to see where retail's involved early in the morning. Now, watch the pattern. See how you're testing in here early? So you already had a test of that area pre-market. Rallies, up, retest, fails, that's it. Some people would even say, I waited for this and then did it there. Whatever. Same thing, same superheated. But what you're doing is you have a test, even if it's pre-market, down, retest. All right, and then you're just pulling money out the same way. It's the same exact trade. And when you see this NVIDIA trade, you'll get that. So in planning this out and how I was going to do this today to explain what we were doing, there's really no other way to do this except for me to walk you through my notes and the notes that John typed out when I'm live trading in the morning. So when we come into that Wednesday, this is what you're walking into. This is exactly what you're walking into. We don't know what's going to happen, but this was our Monday, which was the gap down. This was our Tuesday, where you tried to rally over and then you failed. So this is where we were at, and this is what we knew we were dealing with. And I think that's really important. Hindsight's a beautiful thing with technical analysis, and we're going to spend a little time discussing that today. But understand that when we're prepping for the day, this is what the day looked like. This is all the information that we have. So when you're prepping, all we're doing is this. I'm looking at this and saying, okay, hyper focus on a couple names, watch the indexes. When you have times like this, you want to hyper focus. And then we're just going through the day, make money, and then just get out of the way. And these are just some of the arrows or some of the trades that we're doing. Meta, it's crazy how well that's holding. You know, it's crazy. Just a side note to everybody that's watching this, one really quick tip for everybody. If you're not flipping the 55-day moving average right now, I wouldn't even look at the name. They're the ones that are holding. But what this is showing is just showing names. Like we were playing with Lilly the other day. I didn't hold Lilly into the earnings. I thought there was too much risk. But I think it's important to state that because not everything I do works, clearly. But these are the puts that we're going to walk through, and you're going to see this trade live in a second. But this was the same exact trade, all right? And that's really important. We should probably take a step back, and we should probably go through that right now since we're looking right at it with the timestamp. Now, this is, again, significant, but you always mark off, especially in these kinds of environments, and we'll talk about why you were giving stocks a wider berth now than you were giving them earlier. A lot of people don't know how to use the VIX. I'm going to show you the best way to use it, in my opinion, especially in these kinds of times. So see how this is a pre-market or post-market where everybody had to get in, right? Oh, you got to get in now. Get in, get all you can. How'd that work out? And then all of a sudden you're breaking down, and then you can see those levels right here. It's the same exact trade whatsoever, and I'll show it to you live in a second here, but this will do better, much better. So you're testing up here, you're breaking down, You're trying again, and then what happens? You fail. The retest fails, and that's it. The other thing that you could mark off on this kind of trade is right here. So you have your post level, you have your regular market hour high, and then if you are marking off the open. The thing about the open is you realize that those levels that when you're getting in here, it's right actually here. Let me show the top of that bar right there. The thing about marking these bars, when you do it, it just gives you a really clear understanding of that opening bar, what's going on. So whoever is here on the top of that 1 minute bar, that algorithm, just look at what they're doing. Every time it gets there, you can't even close over it. The one that you did close over it got completely matumboed and just reversed. So you know that whoever's here, they're still selling, right? And we're not even overlaying other indicators here or anything like that. So once you have this, it's the same exact pattern over and over and over again that we did on August 2nd. It's the same pattern that we did with the S&P on August 7th. It is the same exact pattern that we did here, okay, for NVIDIA. So it's the same thing, wash, rinse, repeat. That's your job over and over and over again. And then while I'm doing this, we just see a couple notes out here that I thought were worth mentioning. They're buying names with the most cash, guys. That's very clear. They're buying names with the most cash and they're interest rate sensitive names. This was a really interesting trade. We should do that one. Not today, but we should do that trade. Why this trade worked and how you can identify like short squeezes. But TCA, I bought a bunch of that as well. And then here are the SPY puts that we bought, and it should have the timestamp on 10:15, what we paid for it. And then these are the NVIDIA puts, and you're going to see that live in a second. And then we trim some of those right into it. And then John just does a recap of everything. But this is really what I want to get to. So I've been trying to post less in the room during this time, not more when I'm trading, because this is what you're saying. You just want to let this stuff work when it's working. And I'm trying to let everybody know just patient pays. You just have to be super patient in these markets because it's a macro trade. You can still see like Tesla or TZI close zero off. I'm just telling people where the puts are. And we're watching this stuff hit key levels. Now, you see this at 102.22, and we'll watch this live in a second, this trade. But that was my target. And this is one of the things that a lot of people are doing wrong in this market. You have a very fast market right now, very fast. And you're going to see wicked rises because people are short or they're out of position. Your job as a trader is going to just be setting your targets, pulling money out, and realizing that things could go lower or they could bounce. You know, picture the guy that stayed short Lilly or NVO, and how's he doing right now? Some of these names you can just see, set your support levels up. Like I'm setting right here. This stuff is working right now, guys, and it's going to work next week too. And I think it's important to go there. For example, even here, if we are to look at this, and I can think anything I want, right? So like here on the Tesla, when I got to my levels, my targets, I close. I'm not waiting to see, oh, maybe it's going to break. You know, maybe he's not going to pay the Visa bill, right? So I can see 450, 465. I have my target set. Did that happen? No. Not everything you expect to happen is going to happen. No one has a crystal ball. So when you're getting into these areas, what you're doing is I'm trimming into these, right? There's the SPY puts again. And then these were we had these other puts. And then shop, you're watching it retest that level. And you're seeing a lot of those retests right now, aren't you? But then you're just seeing what's holding the best that's supposed to be holding, but my fingers are like sausages as I type and trade, so that's what they get. They get holder. They don't get an O. They didn't get a vowel. And you can see the retest here. Why is this important? Because I want you guys to see how you're watching these levels that you're drawing over and over again all day. This is Mill getting me into space phones once again. And what you're seeing here, again, I thought Lilly was going to crack, and then you had the earnings, and you're watching these names do exceptionally well. And this is what's important. This is super important. This is what you look like at the end of the day, and you're going to see why this is so important in a second here. This is what you have at the end of the day, okay? This is what it's going to look like when you close, when you go home on the day. And I really want to hammer that point home for when we start talking about Thursday. I went live at the end of the day because I thought it was important, and I just say, every short I have on, I will be out at the end of the day, because you don't know what's going to happen. We were referring to the CTAs. And then at the end, we're just talking about Lilly will move to cash or calls overnight with the trade because I was down in the trade. And we're just talking about some other names in here. And then you're just talking about, again, what Charter's doing, some of the other names. And again, Lilly, you don't know what's going to happen, but market on close. Pay attention to this part of this. Market on close. Watch the last 10 minutes. Airbnb, the last 10 minutes. Look at that chart. You want to watch this stuff right now, guys, because it's going to tell you when there's uncertainty, institutions love stepping in and doing this stuff. They love being able to buy what they really want to buy and mask it at these particular times. And then I just thought there was some other stuff here that was pretty interesting that I wanted to go out there and just show. So at 8 o'clock at night, I'm always typing notes in here during the day because it's a spot for me to leave notes, but also it gives me the ability to leave my thoughts in there for the people in the community. This is what you had at 8/7. At 8/18. Members urge timely rate hike to avoid the need for rapid hikes. This is what I was talking about, staying out of the way. So when you're coming in the Thursday, and we're going to get to this, when you're coming in Thursday, this is the new news from Bank of Japan. So the idea that you're going to come in on the premise that things are going to be groovy is probably not accurate. Let's take a look at the NVIDIA live trade, and then we'll go from there. So you're breaking down here. That's not going higher, guys. How are you going higher? NVIDIA broke. I'm looking at different screens. I'm going to buy some 105 puts on NVIDIA. I'm going to short it with a high day stop. High day stop, guys. Smaller positions. I'm just going to stay in there. Well, that worked out. How about those 105s? What are they doing? They're killing it. I'm just going to leave those on. They don't expire till Friday. I think I caught it. I'm going to go with the wide berth today. We've just rejected this again right here. And I just want to see what happens. So I'm going to have to give them a wider berth on these trades. New lows a day. Are we up on those puts? Yeah, I'm not going to do anything with them yet. We'll leave that alone. Like here, if I was concerned about my short that's in here, I would just pull money out on the way down. It's not a big deal. 280. What did I pay? 2? All right. So I pulled some out of the 105s out. So I just took a little patience today. Now, as always, I hope you found that helpful. I'm going to show a 5-minute chart here because the one thing that I saw a lot of is I saw a lot of frustration. And I get it. It's wild. And what I always say, and even when you look at that, when I showed you the observations of what I'm typing, I'm basically telling people to do very little, stay out of the way, pick a theme. The theme either works or it doesn't work, but stay out of the way. And that's really important here. You have to pick, okay, which way are we going, kind of a theme. And you just don't know. This was Thursday, and I just want to point this out. So this is what we walked into, okay? And this is what we're dealing with, just so you can see Fridays. This is how we went home on Thursday. This is Friday. So if we take a look at Friday, that's what we left with on the week. You come into Bank of Japan on Monday, and this is what you get. Now, everyone's going to talk about this and how simple this was to just buy. It's not simple at all because you don't know what's going on. You don't know the amount of risk that's behind that. You have no idea how much risk is out there right now, and we're going to get to this. But what we want to really point out, we already talked about some of it, but we don't know. You don't know the interbank risk of everybody's leverage to the yen at this particular time. You have no idea. So the idea that you're just going to go, oh, just buy the dip. Okay. So it doesn't work that way. And for people that say that, someday they stop trading. You need a process. But what you're getting here is you're getting this huge rally and then you're getting this dump, right? And now when you get this dump, you're coming into the next day. The next day rips only to stop right here at that low, right? And then when it gets there, it just absolutely falls apart. The only thing that you knew about on Tuesday was that everything that you bought went to garbage unless you got out. And we know that the end of the day is all institutional dumping. That's when they sell. So you have retail buying and you have institutional selling. So I'm going over this specifically for the people that are beating themselves up on the week and saying, I don't get it. I don't understand what happened. You have to pick a side with this, and then you have to go from there. The easiest side is to pick the trend that is working, which was we were breaking down. There's two reasons to see where we flipped. And if you're in the community, you already know what they are, but I want to walk everybody through it. So when you got back to the top of here, we'll get to that in a second, but this is Wednesday. And all Wednesday did was what? Wednesday got you to this level, and you can see all the nonsense in here, and you never got really above that close, and we'll address this in a second. But when you popped over, came down, popped over, this is why I always use the futures because it's longer and cleaner. You can't look at this and go, okay, who buys off the open? Well, retail. Well, what happened for the rest of the day? Institutions sold. Okay, so here we are looking at the market on Wednesday. We're short. The market tries to get over the previous day close. Tries to get over that previous day close. Gets completely matumboed. And you're supposed to come in and look at this market and say, we're going to go higher. There's literally no way that you're going to think that, right? And then on top of that, you're not supposed to gap fill like you did here or how you did on the previous days. So you got to give yourself a little bit of grace, and that's why I'm going through this. No one is going to look at this and nail this perfectly. No one came in and said, I'm long, I'm short, I'm short, I'm long. It's just not realistic, maybe in the movies, but it's just not realistic. And it's really important to get that. You could have said, oh, I think we might hold here. Okay, on what grounds, right? That you're just oversold? Yes, you could use that. And I'll show you how you could have looked at that and said, yeah, we could bounce, we could do this. But all you did was get back to this level. The only time that you really did anything was on Friday when you were actually able to start making these higher highs, and you can actually see those higher highs right here. And then we're going to get into the smart money, dumb money in a second, but I really want to point this out because this is important for people to get. I always would suggest with these levels, when you're looking at the S&P, look at the futures market, because you can see the rejection very here. On Wednesday's rejection, it's so much cleaner. You can see all of Thursday's rejections, and then Friday you can start seeing that they are trying in the morning, down, trying, down, and then you can see how they actually held in here. That usually correlates and tracks really well going forward, right? The futures market. So you always look at the futures over just looking at the S&P, which is frankly an ETF. Once we know this and we have this set up, this is what I want people to understand. Again, we're about to hop in smart money, dumb money here so you can see what's going on under the hood. But give yourself a little bit of grace here, guys. There was anything but this was easy. Anything but this was easy. Two things to go before we go any further. The VIX. And this is one of the reasons why we were able to hold the August 7th longer than holding the August 2nd. On August 2nd, you're doing this and you're moving higher, right? You're moving higher. And people are going to say, well, then August 6th and 7th, that was actually lower. The thing about August 6th and 7th is you're above about that 25, right? That's what made more sense than where we were here. 25 is greater, obviously, than where we were here, and you can see the push through. But that's not the rub. What you have to understand is once this kicks in and you have a move like this, see, what the VIX does is the VIX is telling you the average 30-day range that the S&P could be in. That's what the VIX tells people. People don't get this, but that's actually, if you look at the VIX, what it's telling you. So when you're around 20, 25%, or 25 rather, it's telling you that you could have a wilder move on the VIX. So in other words, if you're at 20 or 15, it's telling you, well, the VIX could do this. I think it's like 4% or something like that. And then when it gets to 20 or 25, you're going to get wider movement and wider moves. Once this kicks in, it all averages in. And you know that if you took these 3 averages or 5 averages, however you want to do it, even if you took the past 30 days from here back, your average here, okay, or here is going to be greater than your average here, clearly because you have this outlier. Therefore, the volatility is going to be greater. And if you know the volatility is going to be greater, then you can expect wider swings in the index. Hence, while here you might not hold your puts as long as why you would hold your puts here. Hopefully that makes sense. The wider that this goes, the greater the downside and upside swings the VIX can have in 30 days. This is a 30-day number, and that is why I always overlay it with something like this. As I've been pointing out to you guys for some time, this is a 3-month number. And what's great about this is when you divide these two together, you can find out where those bottoms are. And we talked about this ad nauseum, so I'm not going to spend a lot more time on it. But the other tool that we are using, and it is extremely helpful right now, you'll remember this flip that happened on July 11th when CPI came out, that RSP started beating the SPY, meaning the equal weight started taking out the SPY, which showed us that we were buying through diversification. We've been talking about this level for some time and making that cross right in here a zero line. And you could see how we were acting on that zero line versus how the S&P was acting. This is where it gets super interesting. We flip here, we saw how we were flipping that area, but look what's happened here. And let's draw this out to the 5th right here, and you can see what's happened. As we started trading in tandem, what's starting to happen here? They're starting to buy the SPY again. They're rolling back into what? Market weight securities versus equal weight securities, right? And again, what you do is you look at this over different time frames and it'll give you a better understanding of what's going on out. But for me, this is really important going forward, and I would watch this disparity greatly. Let's get the smart money done. In front of us is smart money, dumb money. Now, a lot of people are going to be familiar with this that have been watching this show for some time. And what I want to start with is you're going to look at a 5-year chart right here. We're going to look at smart and dumb money. But there's a couple things here that we really need to focus on. Number one, we don't look at it that way. We refer to this as not smart, but institutional. And we refer to this as retail. And the reason that we make that disparity or difference between how they view it. Not everything that smart does is smart. Not everything that dumb does is dumb. But understanding this lets us know the nuances when they move. And what we're looking for is correlations between what smart money does, dumb money, or institutions and retail. And we're looking at that difference and we're seeing how it affects on the chart. Specifically, we're looking at, are they buying? Are they at the upper level or the bottom level? Are they pessimistic or are they optimistic? And that's how we look at it. This is something that is created by a sentiment trader. I have no affiliation with them whatsoever, but they do put out a good product. And I've talked to them about it before and the ability to use this. So what are we looking at here? And what's really important to me is the fact that smart money is up here. Dumb money is down here, and we have the spread. And as you know, there are times where we will look at the differentiation between the spread. But for our purposes, what we really want to look at is where are we with smart money on the optimistic side, and where are we with dumb money? Now, why do we want to do it this way? There's a couple key reasons to start this way. Most of the time, when dumb money is up here, they are places where you're going to peak. Retail is most invested at the top. It's just the way that it is. It doesn't make them dumb. They can move much more nimble than an institution. Also, you will note in these charts, retail is sporadic. They move like a rabbit. Institution moves very, very slowly. Okay, very slowly. And so when retail sells, it tends to drop faster because institution just steps out of the way and goes, go ahead. So when we look at this, understand, and we might as well talk about what happened here. We all know this was the pandemic. And this is when Powell was out there buying houses against people that were trying to be homeowners, and $1.7 trillion was injected into the market, and everybody thought they were a genius, only to find out that it was just inflated assets, and NFTs were nothing but JPEGs. All right, so now what we have is we want to focus on what happens after you don't have an inflated market. So we're going to take out that period of time, and we're going to focus now on the 3-year of the smart money, dumb money, and this is the confidence between the two of them. And we're going to just look for little nuances here and see if we can see anything that starts to pop itself up. The blue line being smart money, and this being dumb money, the red. And what we're noticing is some of these peaks are pretty much denoted here. Now, if retail sells, but retail does not sell a lot, and they only sell a little bit, then that puts us into a different position. Because if institutions are buying, and that's why it's so important to understand the difference between smart money, dumb money, because if we don't understand those differences, let's clean this all off. I got 1,000 arrows here. So what this will do for us is understanding what they are. And since we know that this is retail, well, if retail stops selling and institutions are buying, then we know what's going to happen with the graph. And we know that the graph could still keep moving up. And that's a really important distinction. For example, if we're not overbought on an institutional level, and we're pretty narrowed out like we were here in November, and retail has no investment whatsoever, well, you can see how when we ripped right there in November, what happened. So understanding what you're looking at is one of the most critical things that you can do. Every indicator that you look at, you should have a basic understanding of how it works, not just look at the indicator. The more that you know about that, the deadlier you'll be. And I think that's a really important distinction. So for our purposes, what we're noticing here is that these peaks, after we look at those 3 years, if we look at these peaks, we can see very clearly that those peaks give us peaks here. And that's certainly something that we want to pay attention to. Now, we break it down a little slower just to get in there and really drill into the data. And we look at a 1 year, we can see the peak here, but we can also see that what happened is they stopped. And then when they stopped, we still have a steady flow of institutional buying. But then you get the puke, and then who steps in? Institution, right? No puke, but we undercut. But institutions are buying the whole time of no puke. What does that lead to? Us moving higher. Hopefully you see the pattern. We get the puke and institutions are maxed out. So where does that put us? Well, this is where it gets interesting. The last time that we have crossed to the downside, reversed, and flipped up was a bottom. This was year to date, and what happened, and that was April. And you can see that you've crossed here. So if we look just at the crosses, what does this cross denote? A period of decline. Crossed, a period of decline. The magnitude of that decline is obviously going to be dependent upon the magnitude of the drop. I mean, that just makes sense. If there's more of a drop, it just means you have more selling. And you can just do the simplest of things and just kind of come across here and go, okay, well, that's pretty easy to see that this is an area, for whatever reason, that retail decides that they've had enough of selling. And I thought that was kind of worth pointing out for us to just kind of into. So let's get this just so we know. We know that institutions, this is important, institutions are more fully invested here than they were here. And we know that retail this is the level that we held last time, and that they're starting to lift up. So we would view this as a bullish indicator right now, looking at this graph combined with smart money, dumb money. But let's take dumb money by itself and rip it out and just look at smart money. Now, what smart money tends to do is smart money will put themselves in a position where they are most of the time, they're in no hurry whatsoever. Here you can see them step, and they couldn't get in faster during the pandemic. They just couldn't get in. But these are areas of interest when you peak. Now, why are these peaks different? Okay, they're different because you had $1.7 trillion in here, and that had to puke itself out. This is when they said maybe we can't keep cutting rates and buying equities. Maybe that's a bad idea. And then you could start seeing the drop from here, and then we go forward. So once we worked off all the nonsense that J. Powell and company created, you start getting real rate readings. And that'll take us out 3 years. So what we're going to do with that period of time is just mark that off and get a good sense of that and say, okay, now that we have that 3-year data, what tends to happen here? And then, of course, we have these marks as well, and we can see those lines. But we also know from looking at the previous graph why we're having them. And that's important to understand, right? If we have an exhausted retailer, or we have a retailer that still has more to sell, then we know what the trajectory of this is going to be. But if we have filled, if institutions are filled and retail is going to come in, as we just showed, well, that's a place of interest. Now, we can also look at the year to date here, but I don't think it's really necessary. Because what we would note at this specific time is that we have more smart money, and this is why you want to know what it is, institutional investment than we've had in a year. A matter of fact, if we go back and just zoom out for a second to put this into our situation, we have more smart money investment here than we've had in the past 3 years. This is one of the top 3 levels that we've had in 3 years. And again, we're going to take out the nonsense because of J. Powell and Company. So this is important. Now, when we know that we're at one of the top 3 levels and we overlay dumb money or retail is, what does that tell us? So what we'll do is we'll take each area now and we'll compare it completely separately so that we can see. Number one, if we take this area right here and we look at that, we can see that by the time they peaked, how low you were, and then based upon how low you were, how long this took to turn around and grind out, because they had much further to get involved. If we take a look from this point on and we look at that particular time, we can see where we're down here on dumb money to here. And if we were to take a look from here, how much faster that moved. A matter of fact, even if we took this one, which is not one of the top 3, and we look at how fast this reverted, think about how fast that reverted. Now take a look at where you are right now in comparison to this one and in comparison to this one. And just predicated upon that, you're in a position where you have more smart money invested than you've had. At the same time, you have the least amount of dumb money that has puked. So if this starts to revert, and remember, this is the tortoise, and meaning if they sell, they're going to sell like a tortoise. This is the hare. Right? When you understand what these things are, it makes life a lot easier. And what this is telling us is this is giving us a clear indication not only that we may have bottomed, but that the rally that might lead from this bottom could be more aggressive than what we've seen here and here. Not in movement, not in the magnitude of following it through, but in the speed in which it happened. I hope that makes sense. You're more than welcome to comment below on it, but I thought this was really important the more research I did on it, and I wanted to break it down for you so you could see how I'm looking at things. Now, equity risk premium. This is something that we've talked about for a little bit. Matter of fact, we just went over this. Maybe it was in November when you actually started lifting again through the zero line. And we talked about how significant that was to get back through the zero line and why that was going to lead to buying. You can see that we are pushing up here and we are back through the zero line. Let's talk about why that's important. As always, when we understand what we're looking at, we can then make more informed. If we know what we're looking at, then we can make a more informed decision on whether or not it's something that's relative. So this shows the earnings yield. Now we're going to go over how earnings yield is calculated in a second. It's pretty important. On the S&P minus the interest rate, it's different than dividend yield. Minus the interest rate on the 10-year Treasury notes. Okay, so how do they calculate equity risk premium? What you're doing is you're taking the earnings yield times the interest rate on the 10-year Treasury note, and then what you're going to get is how much you're getting paid essentially for owning stocks versus owning the 10-year bond, which is considered, a risk-free investment. The higher the risk premium, the more attractive relative to bonds. Now, this is important to get, so is the calculation. And the reason it's important is not because you're going to say, good news, we're back over the zero line. No, you could really care less. The people that are going to care are the people that are pension funds. Specifically, very large pools of capital care whether or not you're over the zero line. So in our example, let's say that this is the line and that's a zero. And let's say that your CalPERS are another huge fund. And your assumptions, because that's what you go off of, you assume what you're going to get. Your assumptions are that you're going to earn 5% on your bond portfolio. But all of a sudden, the 10-year starts dropping and it gets to 4%. But your expectations on the year are a little higher. Your expectations on the year are actually right around let's call it 8.5%, and that's going to be way too light. You're never going to see that. So we're going to make that 8.5%. So they need to figure out how they're going to get the rest of that money from that 5% to the 4%, right? They have to figure out how they're going to make up the difference through equities or other alternative assets. Because really, they don't care if they're in the stock market or bond market. As long as they make their money on their assumption where they're supposed to be on the year, with the pension fund, they're happy. So what this leads us to do, this is pretty specific stuff, I understand. I don't think it's too intense, but I think you need to get a concept of why you care that this is over the zero line. Once this is over the zero line, it becomes more attractive for them to buy stock versus buying bond. And what that does is that gets a whole other swath of capital that was going into the bond portfolio that will then go chase the assumption, which then would put money into what? The stock portfolio. And that's why this is important to understand. If you're under zero, then very large institutions such as CalPERS will literally say, well, why it doesn't make 0 sense for us to put more money in equities right now. We can do better with the 10-year than we can on what we're going to earn than what the S&P is going to earn. And this is why are we going into a recession is so important. Are we not going into a recession? Because earnings will drop and therefore demand for equities will drop. And this is one of the core reasons, if not the core reason. See what we did in November? See how we rallied and see how that was sustainable. And then if you go and take a look at what happened at that zero line, when you broke that zero line right here. So let's take a look at this. We would argue that if we were here on that zero line, the day that we broke the zero line would be right around here. And we're going to go right around that March level. We would actually say it's a little closer over to end of March, right? We could actually say that it's probably over here, but I'm not going to redraw that line. How much higher have we gone since that time? Since around mid-March. You'll remember we didn't go much higher. And then look at what happened when the equity risk premium started dropping. All of a sudden, we went away and we started to see the drop. There's a lot of reasons for this, also the blackout period that was going on, but look what happened when it stabilized. Once we stabilized, that was it. So we have a couple demarcation lines. Number one, we have this one that is about as clear as you can get. That, yes, you went a little higher, but then it started to slow down. The next demarcation line would be when we started going flat right in here. Well, that at least gave you an understanding of who was still there. Now, once you have this top, like you have right here, and you broke out of that top, and that's about as good as we're going to draw it, and you're breaking out, what's the market doing? Going down. Does that make any sense? That's not how this works. That's not how any of this works. What happened here? Okay, so when this gets better, it's better to buy stocks. What's happening? And we could say, oh, well, we're dropping. As long as we're over the zero and you're inclining, equity should go higher. Why? Because institutions, I'm not talking about just your hedge fund is going, oh, the equity risk premium. I'm talking about CalPERS. I'm talking about GM's pension fund. Very large institutions like behemoths look at equity risk premium, and they come in and they really pick up supply in the equity markets. This could be one of the core reasons we're starting to see the S&P 500 outperform RSP. It could be one of those reasons why they're buying very specific names that we're going to talk about here. But most important, what I think, is if you're looking at this and you're over that zero line, it's important. And let's walk through how this is calculated so that you can understand the significance. As I stated, we are looking at earnings yield. We are not looking at anything like dividend yield. Dividend yield, you would take everything and you combine it and you get a yield. This is earnings. What is the earnings per share of the entire S&P 500? Divide all of the stocks and symbols by this. Multiply it by 100. Earnings yield formula. 1 times the price earnings times 100, and then you get your number. Okay? We screenshot this, but you can go look it up on Investopedia. But it's important to understand this. Why? Why is it important to understand this? Because if earnings on the S&P drop and rates stay the same or drop, then nothing changes. But if earnings go higher and rates drop, well, then the risk-free rate goes up, which makes pension funds want to put more money in the market. So it's really important to watch the equity risk premium to understand where the big guys are putting their money. And this could be one reason why we're also seeing smart money lift the way that it is. Now, before we go over another core concept with this, I really want to hammer this home. This is dividend yield. You're at a 132 on dividend yield. People will say, oh, the dividend yield of the market is here. No one really cares what they're getting for buying the S&P 500. You do, but you don't. And these are just pointing out bear markets, when it spiked. And so you can kind of see on those spikes but really just seeing where the earnings yield is right now. And frankly, no one really pays that much attention to that. They care about the growth in the earnings. But I just thought it would be important to walk through this. You can see you're at a 3.6 at this particular time when I screenshotted this. and that shows that's where the earnings yield is right now. So there's actually people that chart this, and you can actually start seeing the earnings yield drop. Why is the earnings yield going to drop? Because as the S&P goes higher, if earnings stay the same, then the yield's going to drop. If earnings go higher and the S&P goes higher, then whatever one's going higher predicated upon earnings, right? That's what's going to happen. This is so much more important, equity risk premium. This is so much more important than people saying this is the PE of the market and that's expensive, because it's the correlation between the bonds. It is the correlation between the bonds of a 10-year treasury and the equity and what that earnings on that equity is doing that makes all the difference. Not if, oh, when they cut rates, we definitely drop, or we cut rates, we definitely do this. The only thing about cutting rates and what happens when you cut rates, and I'll walk through this, is that dividend yielding names go higher. That's the only certainty about when you cut rates. In 1995, you had increased productivity via the internet and you cut rates like a madman, and the market exploded and went through one of the greatest bull markets of all time. You currently have increased productivity right now. They are going to cut rates. Okay? Take from that what you will. You never know how it's going to play out, and you have a lot of other extenuating circumstances with war, political upheaval, Bank of Japan, but understand that it's not that simple. I will leave you with this. It's your job as an investor or as a trader to do the simple things, to look at equity risk premium when people are talking about, oh, they're cutting rates, therefore the market's going to drop. Now, they're cutting rates because they're thinking there's going to be a recession. And if there's a recession, then earnings are going to drop. But in no point are you ever going to look at this chart and see a breakout like this that's led by something like this. The reason for that is because they're saying one of two things is going to happen. Either yields are going to go higher or earnings are going to drop, and they're trying to catch it, and that's why it spiked. But what's happening is you're balancing out here and you're starting to catch, and people are realizing that earnings are not dropping. This is really important because this is a massive divergence. And the last time that we had something like this that really moved us was back here in November, and I will leave you with the fact of this high on the market back here was actually marked by when we broke the zero line. As always, you're free to comment on this. I'm always curious what people think about it, but this is a really important concept and will help you identify institutional flow significantly better than probably anything else that you're currently using. Okay, so we covered a lot of ground today, obviously, and what I want to do is we're going to follow up with this on Monday. So you're probably going to want to watch Monday's video. I'll get more specific on what I see going on with individual names then, but for time's sake and to not inundate everybody, what I'm going to do is just give you some basics that I would look at. I would look at three very specific. Number one, you held here and you are forming what I would refer to as, it's not a dragonfly, but the mother of all hammers. This is really good, and they usually can act like a slingshot if you lift. What you do is you take the measured move from here to here, that flip, and then you can kind of measure it out. So if this was going to turn itself into a morning star, you'd be looking at getting back to that 5,600 level. Nevertheless, that's there. There are three major charts that I would look at here that I look at on a weekly basis. Number one is I just look at RSI and see what's going on. And I would be remiss to not point out that you have a negative divergence here. And we should talk about it just so you say it. It doesn't mean it can't remedy itself. It doesn't mean that it didn't already remedy itself with what we saw, but it's there where we've made a higher high and you have a lower high here. You've already come back to this level, and sometimes that's enough for this thing to work itself out, and it's done that. So you may have worked that off, and we are back there. I would watch to make sure that you are not breaking that 50 level on the weekly. That is the first thing that I would look at. Now, the other thing that I tend to look at with the MACD on a weekly is I do watch the crosses. And I would point that you also have a negative weekly divergence here. And has that turned yet? No. As a matter of fact, you have actually undercut that right here, and you can see it. So we have to be cognizant of everything that's going on, just not the things that we want to see, but of everything. So if we have that, we can see that as well. The next thing that I tend to look at is just my long-term position with this cloud, and this is just the Ichimoku cloud. And what I would point is, since you flipped here, which is really significant, let's take a look at this real quick so you can see what I'm talking about. Every time that you pop over this, you're good until you're under. It's really that simple. It took 30 years for this guy to create it. You know, I would learn just how to follow just the cloud part of what he created. It's worth it. But I think it was actually my most popular video I ever did was just the edge. You can see how you're still above it, right? And so nothing long-term has really really changed here. But you do have some intermediate indicators that are saying, okay, well, yeah, we do have a negative divergence on those, the MACD and the RSI. And has that worked itself out? We don't know. What we're going to want to do is see if we can flip that 53.85 and see if we can push from there. That's it.